Ladies and gentlemen, good day and welcome to the Tech Mahindra Limited Q4FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. C.P. Gurnani, MD and CEO of Tech Mahindra Limited. Thank you, and over to you, sir.
Hi, good morning, good evening, everybody. Welcome to Tech Mahindra Q422 and FY22 results. Thank you all for joining us today. We are excited, happy regarding our financial performance and overall as a company investing into future. It's been a great year. We started the year, when I look back, with a new framework, which is Next.Now. Next.Now was really taking into account the next range of technologies which will lead to business transformation. We took into account some of the unique features of the company, which is communications, content, creativity through Born or Pininfarina, and also on commerce, which is really how to help our customers grow. Now, this 4C focus, I think, is worked well for us, and our theme of Next.Now, which is basically to be agile, to anticipate the future, and do it now, has worked well. Just to give you an example, February, our leadership did a simultaneous launch of TechMverse in Barcelona as well as in Hyderabad. Again, very, very well received, and we believe that today our use cases are helping many, many customers. Few people on e-commerce on NFT, few people who are looking at creativity, few people who are looking at solving business challenges in retail sector, or in some cases working on the content again, which is about the teaching platforms or education or simulation for the sports. So your company will focus on 5G, will focus on the Wave 2. Wave 2, as you know, is an internal program which looks at data flow from IoT, from various devices, from various other sources, and how the data is, managed, how the data is, not only managed through conventional tools and platforms, but also through AI, how the data goes through edge computing or data centers or the cloud, and how we are able to secure the data. Now, that journey for us is Wave 2. And I think overall Next.Now has resulted in good results and good value creation for our clients. Company overall signed more than $3.3 billion of large deals. We saw some of the very big large deals in mainly in CME and BFSI. We are lucky and happy that our 5G investments are now yielding results. Our cloud business is growing, very, very healthy. Overall, I can say that FY22, as Rohit tells me, is that it's one of our best years in 7 years. So I can only say so thank you, all of you, for supporting us in FY22. supporting us in the previous years. I know Q4 results take us to almost a $6 billion company, constant currency growth of 5.4%, overall deal win, large deal win of billion plus. CME business growing over the last 6 quarters consistently. I am only glad that I have a great team and I have this leadership team right on this call. So, thank you for your support. The board recognizes that our capital allocation should continue to reward the shareholders in short term also. So the board has recommended the final dividend of 30 rupees per share in addition to 15 rupees per share, which was earlier given as interim dividend. My focus for FY23 and my management team's focus is organic growth, continue to look for improvement in our EBITDA improvement programs, and continue our focus on Wave 2 and Metaverse. Connectivity, Wave 2 and Metaverse will continue to be our focus, leading to business transformation. I want to thank you all for attending the call. Handing over to Milind and Rohit to update us on all the financials. Milind, over to you. Thank you, guys.
Thank you, CP. Good evening and good morning, depending on the time zone you are in. Okay. Let me cover the company financials for the quarter ended March and for the year in little more details. We ended quarter with a revenue of $1,608 million versus $1,533 million last quarter. A constant currency growth of 5.4%. And as CP alluded, balanced growth with CME vertical growing at around 4.8% and enterprise growing at 5.8%. We had another quarter of a strong deal wins with TCV exceeding $1 billion for the second time in last 2 years. Now, overall increase of about 50% plus in the over the previous year in terms of TCV win. Revenue in rupee terms was about 12,116 crores versus 11,451 crores, which is a 5.8% growth in revenue terms, in rupee terms, sorry. EBIT for the quarter was about $211.5 million versus $228 million in Q3. EBITDA margin for the quarter was 17.2, lower by about 80 basis points compared to the Q3, partially on account of lower utilization, which is in view of the recruitment which we have done for the growth and juniorization, salary and retention related impact because the cost, the supply side pressures still continue. And there were some one-times which were there in last quarter, which obviously have not got repeated in the current quarter. Then there was an additional charge of about 80 bips on account of depreciation and amortization. Depreciation because of additional investment in the hardware and software which we have done in the current quarter, and amortization resulting from the acquisitions in the quarter 4. Where the impact on in terms of cost was for the full quarter, but the benefit we got was for part of the quarter. So moving below EBIT line, our other income was higher at about 42 million compared to 30 million in the last quarter, and the increase was mainly contributed by the forex gain, which was about $27.8 million versus 17 million in Q3. We continue to follow the hedge policy which the board has adopted for last many years and that consistent hedging has helped us to deliver good returns over the period. One redeeming feature for this quarter was the tax rate was about 17.5% as against 27% in Q3. And this was on account of one-time reversal of tax benefit, tax provisions related to SEZ benefits. And that is result of two factors. One is the pickup in the investment in plant and machinery in last year, and our decision to opt for new tax regime from FY22, which means the investment that we will do in the next 3 years will be available for the utilization of SEZ investment reserves, which till FY21-22. Now, we will be under new regime, as I said, from FY22 onwards, and our normalized tax rate for the company would be in the range of about 26%. Okay. The net profit margin for the quarter is 12.3%, which is an increase of about 30 bips over the last quarter. Free cash flow for the quarter is about $111 million, which is 56% of PAT, lower than the last quarter, and the cash flow was impacted because of the additional hardware investment in hardware and software, as well as some OpEx payments which we had to make for the future. Okay, and so some of these benefits you will see as we go along in the coming quarters. Our DSO days, which have increased last quarter, have improved by about 4 days to 97, and we hope to continue on that movement. Moving to full year performance, the revenue for quarter, we almost at 6 billion as CP alluded to. We were at 5,998 million, a growth of 17.3%. During the year, our communication business grew by 17.2%, while enterprise business grew by 17.4%. In the enterprise, technology and BFSI were major growth drivers for the current quarter. When it came to coming to CME, the 5G revenues helped us to accelerate the growth there. EBIT margin for the full year at 14.5%, which is about 30 bips improvement over the previous year. In absolute terms, EBIT for the year was 872 million. Our EBITDA for the year was 1,076 million, a margin of 17.9%. In terms of our other income for the year was 149 million, significantly higher than the previous year because of higher forex exchange gain. Forex gain was about 75.5 million this year, as against 12.6 million last quarter. Free cash flow for the full year was about $595 million, about 80% of the PAT for the year. As CP said, the board has declared a final dividend of 30 rupees per share, and with an interim of dividend of 15 rupees per share, dividend will be 45 per share, same as last year. As I said, we continue to follow our hedging policy consistently. Our hedge book was about $2.2 billion, almost similar to last year. And MTM gains as on 31st March were about $571 million, of which $16 million have been taken to P&L, and 55 million are in the balance sheet based on the accounting that we do. Okay. In summary, I would like to reiterate that we are taking the right steps towards transforming our operations as we continue to focus on growth momentum moving into new fiscal. With this remark, I will now open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. So first is on, had a couple of questions on margins actually. In the last quarter, our SG&A was around 12.1% of revenue, and you had suggested that it could go closer to 13% on a sustainable basis. But this quarter also it seems to be just about there. Is there any specific one-off there, or how should we think about this particular cost item?
So Nitin, for convenience, I'm going to request Rohit Anand to coordinate all the question answers. So Rohit, can you take over, please?
Yeah, CP. Sure, thank you. Yeah, so Nitin, from a quarter-over-quarter perspective, there is absolute increase of $10 million in the SG&A spend. While as a percentage, yes, we've not seen that increase so much come through, but nothing from a dramatic one-off that we see this time versus last time, which is reflecting from a P&L standpoint.
Sure. And from a margin perspective, overall, if you look at EBIT, how should we think about it on a going forward basis? I think you mentioned something on depreciation. To give a broad color on puts and takes on margin and how we should think about it on a going forward basis.
Yeah, sure. So I think from an EBIT perspective, maybe the way to think about it is, from where we are, let's look at a little bit of recap. I think from the year perspective, we've at 14.6%, right, at an EBIT level, based on some of the charges that came in 4Q, which I'll talk about. I think barring that, we were very close to the range that we had outlined for the year. So we're in the ballpark. And we look at as we move forward, right, and where we are from a quarter perspective. What has happened through the year is the salary. Sorry, can you guys hear me properly?
Yeah.
Yes, sir, you're clearly audible.
Yeah, we can.
Okay. So what's happened through the year is the salary cost and the retention based on the supply side pressures has continued, and we've also seen in the second half a little bit of advantage come through for price, but that's lagging the cost increases dramatically. So as we move forward, when you look forward, one of the big levers that we'll continue to work on with our customers is going to be price increase, right? So that's one looking forward from a margin standpoint. Second, we've invested consciously in the last 2 quarters for future, which means we've invested in juniorization. We've done a lot of fresher hiring, and that's the long-term impact we want to get to bring our average resource cost down, right? But that gives a short-term impact. So our utilization has gone down. If you look at that from a 2-quarter standpoint, we were operating at almost 87+%, which has gone down significantly. So as you look at the future, there's an upside on utilization that will pay out, right? So that's the second broad trend as we look at, right? Third, I think we've continuing our journey on offshoring. I mentioned that multiple times before. As we look forward, I think we see a definite improvement opportunity for us available on doing more and more offshoring. And short term, the demand because of travel restrictions, etc., has also been fulfilled onshore. And that, as a lot of deal wins that we've won, the work will start getting transitioned to offshore. So that will be an opportunity that we'll see. If you see our subcontracting costs, right, that's another lever that's gone up to get the growth that we've enabled this year. But as we stabilize in those programs, as we get maturity, we'll continue to work two things. One, wherever the resources required to be onshore, those subcon will be replaced by on-site people who are full-time headcounts, and also there we'll play the in terms of how do we hire the right fit candidates. That will give us an advantage from a cost benefit by substituting subcon to headcount, right? So that's another lever that will play for us. And then this also I've mentioned in the past, and we're continuing pursuing it. We're trying to look very strongly on geographies that are low margin for us, countries that are not giving us the return we want. We're taking conscious effort on picking those portfolio out which doesn't fit strategically, which is not giving the return, one, by organically not focusing on that, or second, package it from our perspective. So we're seeing that, can we make a better realization for somebody else there, right, versus the fitment to our portfolio. So those efforts, in our perspective, will give a better business mix as we look forward and give us upside from a margin perspective. So these are the levers, as we look forward, will continue to work for us. And well, right, from a supply side perspective, salary cost, travel coming back, some of the facility costs, while we continue to work on a hybrid model, those will be the headwinds for us. But given this and the growth prospect, given how the deal wins have been and what the pipeline looks like, it makes us continue to believe we'll continue to progress as we go sequentially to the quarters for the year to improve our margin story as we move forward.
Sure. Thank you, Rohit. I'll fall back in the queue.
Thank you. The next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity. So Rohit, a question on the revenue outlook. If I look at this year, you have added over $700 million of organic revenues. And now for the next year, if I see the deal booking this year, of course, has been 50% higher than last year. So how should one think about the incremental revenue addition on an organic basis for next year? You think we should sustain this level, or it could be even better than this?
Pankaj, as you know, obviously we don't give guidance, but I can give you some trends that we're seeing from a market and our vertical perspective that give a flavor of what the future is, right? Communication, right? You've seen that grow consistently over the last few quarters. So that, from our perspective, deal wins that you see in the quarter is almost $600 million plus of the billion that we got in the fourth quarter, including a significant win that CP also mentioned on the 5G space. So communication, with all the levers that we set on 5G are kicking for us. So that will continue to, including the pipeline that we see, that will continue to fire. So that's a positive for the year from a momentum standpoint. Second, if you look at enterprise, from the different vertical perspective that we've articulated before, technology continues to be a positive momentum for us, while we saw some quarterly fluctuation the last one. But as we look going forward, that's another area that consistently will grow for us similar to last year. We're seeing a ton of opportunities in the technology space. So that's the second area where we're seeing demand continue, right? And then, you've seen BPS. BPS has grown significantly for the year. And when we look at the way we are bidding for deals, the way the opportunities are stacking up, that's another area where we'll continue to offer better solutions to our customers. And we've also done a lot of solution and capability adds in our BPS segment, including consulting, getting earlier in the cycle from a BPS process perspective. So that all from a go-to-market perspective is coming together for us to give us better leverage on new deal wins. So that's another area that we continue to see positive momentum. And then the whole, customer experience area, the XDS pillar that Dilip Keshu leads, and we've been talking about that. That continues to help us a lot on giving the positive side on deal wins. And a lot of deals that we win, which gets reported, they play a very active role in helping overall solution on customer experience standpoint. So I think from a momentum standpoint, as we were, last year, same time, our pipeline's looking good. Our deal win momentum is similar. We ended the year last year with a similar deal win, and that's the same position we're in. So that's kind of from a demand standpoint, Pankaj, that we see. And geo-wise, you've seen Europe. We made some leadership changes there. We put different leaders. We articulated it that segment was slowing down for us. That gave us a positive momentum in the year. We've done similar changes in the Americas segment, and that again this year from a geography mix standpoint, we aspire to continue to grow.
Fair enough. Any headwinds you see, maybe not immediately, but in the second half, given the kind of macros that we have?
So difficult, Pankaj, to kind of really outline right now. What we're seeing is visibly the pipeline. The pipeline continues to be strong. I mean, there could be certain short-term pressure on costs that might come at the client perspective, but it's also an opportunity for them, to use our capability to even give them, better structuring, long-term structuring of the cost, right? So it's an opportunity for further offshoring for some of the clients, right? Because they get the cost pressure. So it'll play out from a short-term, medium-term perspective. We are proactively working with customers early to give the right solutions upfront so that they can think about what is bothering them instead of having knee-jerk reactions. So I think those discussions are early in the phase, but overall we're not seeing too much reactions come through. Maybe I'll just ask Manish and Vivek for their segments, and Jagdish if they want to quickly comment on what they feel in their segments.
Sorry, you want me to go first, Rohit?
Yeah, Manish, why don't you go first?
Yeah, no, absolutely. I think the overall trend, as we have been saying through the last year, has continued to play out exactly in that fashion, which is the digital transformation driven by 5G and the need to be ready for 5G revenue growth, whether in the consumer realm or in the enterprise. That continues to drive the transformational activity within the telecom ecosystem. What also continues to drive growth for us is the adoption of cloud. That is also a pretty solid secular theme across the world. And that's largely for transforming their existing stack, as most of it will continue to drive the digital transformation as they adopt some new software as well. So I think those two broad themes will continue. What has also been helping us over the last year or so is the investments that we have made in our digital engineering capabilities. And that's as well helping, where now we are in pretty good positions to provide engineering capabilities in the metaverse ecosystem, from network to devices to applications and use cases, or for that matter, offering software product development and capabilities therein. That's also another solid theme, that is continuing to emerge. And like Rohit said, there will be some pressures because as the economy evolves, there will be pressures to try and conserve some cash. But the broad demand sentiment remains that the telecom ecosystem has benefited a lot over the last 18-20 months by digitizing as much as they can. And we believe that that process will continue. And we continue to have that privileged access rights across all the major operators for us to get a pretty good view of what's happening from some of these transformational projects to be able to take advantage of, whether it is in the network space, in the infrastructure cloud space, or in the software transformation, all three.
Rohit, thanks. So I think just from a BFSI perspective, we had a good year with a 19% year-on-year growth. That obviously takes us on a certain trajectory as we look into next year. Q4 obviously included the CTC acquisition. And as we explained it in the last earnings call, with that acquisition, we've now created a standalone focus team to drive insurance growth and drive synergy with the new acquisition. And we're making good progress there. And I think just reiterating what Rohit and Manish said in different contexts, that we do continue to see robust demand. I mean, there isn't any impact on the wider economic issues or the war on the demand scenario right now. Jagdish?
Sure. So thanks, Vivek. So I think overall, couple of things that are playing out in our strength. I think overall for the enterprise business, but I guess for the whole company as well. Large deals specifically, I think we've more than doubled in our performance from last year to this year. And that I think augurs well in terms of what we see as an opportunity, and we aim to add, at least $1 billion revenue next year. And we add about $1 billion of deal wins each quarter is what we're trying to go to, and maintain that momentum, which should show a good number of, sequential growth. As far as the verticals are concerned, especially on manufacturing and high-tech, manufacturing, as you know, for us includes auto, discrete, oil and gas, and utilities. All of them have shown more than double-digit growth this year. They are also promising enough to be able to manufacturing for us is very close to BFSI in terms of $1 billion vertical, so we should hit that very, very soon. And the rest of them, in terms of high-tech, etc., should start entering that league at the end of the year as we get into that kind of a run rate, at least upwards of sequential growth-wise, upwards of high double-digit towards high teens. So bullish on large deals, bullish on the vertical growth, and as we said, primarily transformation towards revenues from Americas and Europe. That's where we're seeing most of the growth happening.
Got it. Thank you for the answer. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, hi. Good evening. Thanks for the opportunity, sir. I have only one question. How you are seeing the demand for telecom and enterprise evolving? Do you see that telecom demand, particularly in the 5G, will take over the demand in the enterprise side, or you think that it is too early to call that out?
Right.
Sorry, you want me to take that word?
Sorry. I was on mute talking. Apologize. I think Jagdish and Manish just articulated that, but maybe quickly, Manish, if you want to just add anything to what you just explained.
Yeah, I think if I understood the question, your question is will 5G in enterprise overtake the demand in enterprise from other digital transformation areas?
No, I just wanted to understand whether, going forward, you see more demand in 5G coming in, or you think that enterprise business will equally grow strongly, or, it will be ahead of telecom. What is the sense on that? And also, if I can add another question on the attrition side, when do you think that, the attrition will cool off? And where is more attrition, whether it is more in enterprise or in telecom? Thank you.
Okay, so I think let me comment on the growth. I think I did in response to the previous question. I did highlight where we are seeing the demand sentiments coming from within the telecom ecosystem, and that, like I said, is largely, and we have been consistent about it. If you recall that this is a wholesome, very comprehensive digital transformation that is underway. And digital transformation in the telco realm is not just about changing the front end or changing some BSS systems. it goes all the way back into the way the networks are operated, and before that, how networks are built, and how the network compute happens now, going forward with a cloud-based model. So in totality, it is a complete transformation that is underway, and we believe that this momentum of where the need for continuing and completing at least this phase of the digital transformation is going to still continue to play out the next 12 months also. Our pipeline reflects that. Our current advanced conversations with various operators indicate that. And clearly, what is driving most of that digital transformation is clearly the power of 5G and 5G protocols that will allow the operators to offer services to their enterprise customers, to their partners, and to their consumers slightly and very differently with what we have done in the previous generational wireless technologies. So that's going to continue. As far as the enterprise commentary is concerned, I'll hand it over to Jagdish and Vivek, because I think they've given you broad answers about how the growth cycles will be.
So, Jagdish, if I may, Sandeep, I think to your exact question, I think the great news is that, as Manish articulated, that's 40% of the business. We are seeing great demand driven by 5G and everything else. I think on the enterprise side, between what Jagdish and I said, high-tech, BFSI continue to grow very well for us. So it's a healthy competition between the two parts, right? Where can we outdo each other from a growth perspective? But the demand scenario is pretty robust across the board.
Thank you. And on attrition, I mean, there's no specific trends between the verticals, but it's more driven by the skills. Certain high skills, niche skills, we see that trend higher. That's the general trend, but not across the two segments. I don't know, Harsh, if you want to add anything. We've seen improvement on attrition sequentially quarter-over-quarter at point of time, while LTM continues to be flat. So that trend is improving. But Harsh, you can comment if you're on the call.
Yeah. Thanks, Rohit. Can you hear me?
Yeah, we can hear you, Harsh.
Okay, great. So Sandeep, thanks for asking that. As you would see, our trend, we've actually bucked the trend by showing a flat on attrition this quarter in the last 12 months. But if you really look at our quarterly annualized number, we've seen a considerable downward trend. Now, obviously, that means that all the efforts that we had put in place about 4 quarters ago or 3 quarters ago seem to be paying off now. As Rohit said, we don't see a particular trend between CME or enterprise. It's more, skill-based as well as, tenure-based. So we obviously, at the junior level, we probably see slightly higher, as has always been the trend. But the real good news is that our quarterly annualized number is actually coming down, which is really bucking the trend from last few quarters, as well as from what we see in other companies. So that's a very healthy sign for us. And we do believe that all the steps that we have taken at Tech Mahindra will ensure that this downward trend continues and the stabilization of attrition happens.
Thanks. That's very helpful. Thank you, and best of luck for the current quarter.
Thank you. The next question is from the line of Surendra Goyal from Citigroup. Please go ahead.
Thanks. Good evening, everyone. Rohit, just wanted to know when the next wage hike cycle kicks in. And secondly, do you expect the Comviva seasonality to impact margins in the coming quarter? Thanks.
Yeah, Surendra. Sorry, I didn't get the second part of the question. Could you just repeat?
So I was talking about the Comviva seasonality in the business, and do you think that impacts the June quarter margin?
Yeah. So from a salary hike cycle perspective, while we're already doing some sequentially in batches, but the main cycle is for us going to be July. And from a Comviva perspective, we've structured the business where we've, over a period of time, reduced the seasonality impact that we typically saw in the last few years. While it will be still there from a June quarter standpoint, it will be relatively lower than what we've seen in the past.
Sure. Thanks for that. And could you also comment on visa costs? Any idea about the quantum and timing of that for you?
Timing usually is going to be the current quarter, Swain, and from a quantum standpoint, say it'll be maybe an impact of 25-30 basis point from a margin standpoint.
Yeah. Thanks a lot, Rohit.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Yeah. Hi. Thanks for taking my question. Rohit, just one small question. On the extra incremental depreciation and amortization cost that we saw this quarter, that's going to be a recurring one? So basically, should we model the current the number in this quarter going forward as well, or was there some one-off cost in terms of acquisition which was there in this quarter?
Yeah. So I think for next year, the way it works is some of the amortizations, obviously for one odd year, so that's a reduction that will happen, but not for this year. It will be a reduction for the following year, right? And in the quarter, while there was some catch up, etc., but broadly you can assume that to be recurring as we move forward.
Got it. And any other incremental expense that you're expecting, maybe from any of these acquisitions which might not have been fully integrated in the next quarter to hit us, or do you think everything has been taken into account in these quarter numbers?
Yeah, I think we've done a thorough due diligence, so we've accounted almost all the activity that happened.
Got it. And just again, maybe one last, if I could squeeze in, any color of the tax rate, should we consider it to be in a similar range that we've had before?
Sorry, any color on? Sorry?
On the ETR tax rate.
So, on the current quarter, is the question?
I mean, going forward,
Yeah, our range going forward that we've articulated is around 25 to 26%. That's the range that we modeled, and we end up being that on a normalized run rate basis.
Got it. And this quarter was exceptionally low.
Yes. We did have some benefits that we got on account of SEZ, so that's reduced the effective tax rate for the quarter.
Got it. Thanks a lot. Thanks for taking my question, and wish you all the best.
No worries. Thank you.
Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi. Thank you for giving me the opportunity. So two questions. Firstly, when I look at your commentary, when I look at the deal win numbers, it's significantly better than the last year. So is there anything that precludes you from commenting that next year growth could be better than the last year? Is macro creating that kind of uncertainty which is precluding you from saying that? Or are there any other factors around renewals or anything which one should be aware of from a growth perspective for next year?
So, you heard Manish, Jagdish, and Vivek talk about it. From a demand perspective, it's looking favorable, right? Across the sectors, we're seeing positive demand. Discussions are favorable. Communications, obviously, to our strength and the capability that we have. And when we look at also the pipeline, where we were last year to where we are now, I think that is also showing significant improvement, right? So all the trends are positive. And from our perspective, as we discussed, macro is obviously an uncertainty. And how it pans out as we move forward, I mean, it's very difficult to predict. So I think that definitely is something that we'll have to keep on monitoring as we move forward quarter over quarter, though right now we don't see that in the data.
Got it. Second question is on margins. Your X of amortization related charge around acquisitions, your organic margins would be in ballpark in the range of 15% in fiscal 22. What kind of a pricing lever is required to be able to absorb the incremental cost on hiring, et cetera, and manage stable margins in fiscal 22 on an organic basis without including the effect of amortization? And secondly, within the amortization, is there any schedule that you can share which can help us to model it better from a 12 to 24 month point of view? Thank you.
Yeah, so pricing is one of the big levers, but I mean, not the only one, right? So there's definitely a lag on pricing. As I mentioned, we've seen some positive impact come through in the second half, more towards the fourth quarter. And I think the active discussions by the commercial delivery and the leaders are moving in the favorable direction. So that should start kicking in. But that's just one of the levers that will be required for us as we move into next year. Beyond that, as I mentioned, a lot of focus being driven on business mix, growing geographies that are giving us better return. Also kind of looking at low margin areas where don't fit us strategically, trying to actively work on finding the right fit there. So I think beyond just pricing, which is going to be an active lever as we move forward, it's a bunch of these actions and some of the investments we've already done on juniorization that will start kicking in for us as we move forward with utilization rate going back to the levels we were comfortable with, which you saw first half of the last year.
Great. And any schedule for the amortization charge for 12 to 24 months just to help us model the DNA charge better?
So it'll be, as I mentioned, I think from a run rate perspective, FY23 will be similar, what you've kind of seen. And as we go into the next year, the following year, it'll go down. Specifics, I think Kaustav can help share with you.
Sure. Thank you.
Thanks.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. One question in terms of acquisition intensity. We've spent almost 940 million plus on acquisition since the start of last year. In terms of acquisition intensity, how are you seeing things going forward? Do you think this pace continues, or we'd look to consolidate our acquisitions and possibly focus more on organic in the subsequent years?
Yeah, so I think from a capital allocation standpoint, this year is going to be more organic focused for sure. We'll focus on consolidating the assets that we've acquired last year. I think a lot of work has to go there to make sure that we set it right, get the structure going, and make sure that we can long-term get the benefits of synergy that we've planned for those assets, right? So that's the view. So you're right, the focus is going to be more organic and getting these aligned to our infrastructure overall in the structure so that we get the right potential benefits. And Vivek, you can also add anything on this front.
No, I think Rohit, you laid out the direction. I think the only color I would add to that is that we've always stated in terms of our acquisitions are largely focused on fulfilling capability gaps. And we've done a lot of them over the last 18 months. And hence there is, less white spaces to go after. That's just an outcome of what we've done. And hence the focus will be on driving synergies, driving integration, creating value from the investments we've done in the last year.
Thanks. And just one follow-up on an earlier question. So from an SG&A perspective, do you still think you'll go back to those steady levels of more closer to the 13% odd levels, or there have been some structural savings that maybe help us operate at the current levels?
I think there will be upside movement to the current level for sure. I think there are a few areas there from cost increase perspective. One, obviously, we spoke about facility at some point coming in. That's the infrastructure cost that we have. And some of the other costs that has been subdued for us for the year. But I think as the operating leverage and the growth continues to pick up and the demand continues to be what it is, I think from a leverage perspective, we might see some benefit, and hence maybe it'll be somewhere in the middle that we might land up, while there might be some quarterly variation.
Thanks, Rohit. Thanks for the answers.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First, about if I look our standalone profitability, it declined sharply, 430 bips quarter-on-quarter. So can you help us understand what played out in standalone numbers? Second question is about fresher addition. I think you alluded to we have increased juniorization. So can you help us with some data about how many freshers we added during FY22 and how we intend to increase for 23? And last question is about the EBIT margin aspiration. Earlier, we always alluded 15% EBIT margin aspiration and over medium term taking it to high teens. How we look that number shaping up for 23? Thanks.
Yeah. So I think first question from you was on standalone. So I think you've got to look at it consolidated margins because there's a lot of intercompany deals and transactions that happen that truly don't give the right picture. I think that's the way to look at it. So that's one. Second, in terms of freshers, we've added more than 10,000 in the year last year, and I think, as I mentioned, one of the big levers that we will continue to drive is juniorization and addressing the pyramid. So I think that's an area we'll continue to pursue while we move forward into this year as well, because it's an important area for us to structurally address the cost structure, right? So that's the second point. And from a margin standpoint, I think, as I mentioned, when we look at this year, we've been, organically close to that number that we had articulated. I think for following year also, our positive levers that are articulated, we'll continue to drive it through the year. And, from a journey perspective, continue to pursue sequential improvement through the year and get towards a similar range that we'd articulated last year.
Understand. And when you are saying sequential improvement, you are referring from Q4 exit. We expect Q1 to Q4 would be better kind of trajectory?
Sorry, I didn't get that question. Can you repeat, please?
You said one of your comment was we expect sequential margin to improve. Now, in that, one of the quarter would have salary, right? So I just want to understand from Q4 to Q4, we should expect steady improvement in trajectory or how one should build it?
Yeah. So I think they probably, cyclic, as we mentioned, there are certain cyclic aspects for us, right? So we spoke about seasonality of Comviva that comes for Q1. There's certain visa costs, etc. So there is certain cyclic nature of cost that comes in Q1 for us. So I think looking at that, there will be certain headwinds going into the quarter. But I think, as I mentioned, the positive momentum that we're seeing on all the actions are starting to yield results. As I said, the cost obviously increased last year and lagging by the price increases. The price increase momentum is coming in, right? So I think as that kicks in, that will start offsetting some of these impacts. And as we move forward, in our view and the way we're driving these actions, the positive momentum will carry us through better margins through the quarter moving ahead.
Understand. Thank you very much.
Thank you. The next question is from the line of Manik Taneja from JM Financial. Please go ahead.
Hi, thank you for the opportunity. Am I audible?
Yes, sir, you're audible. Please proceed.
Rohit, sorry to pester you on the margin outlook. I just wanted to get a sense as to what are the different moving parts that have impacted our margin performance in second half of the year. Because 6 months back, you hosted an analyst meet, suggested significant confidence on sustaining 15% EBIT margins, and then subsequently in second half you missed, or margins have been lower than that level. So if you could help us understand what are the different levers that have been working against you now. That's question number one. And the second thing is, do our wage hikes happen in one single quarter now, or because I caught one comment suggesting that wage hikes might be happening, would be spread out during the course of this quarter and subsequent quarters. So if you could help us understand that. Thank you.
Yeah, so I'd mentioned, maybe I'll take the wage hike first. I'd mentioned that we do that in batches, but there's one big batch which will be predominant that we said is going to be end June, July, right? That's the point we mentioned from a wage hike perspective. No, from a margin perspective, let's kind of backtrack on what we said. I think we said that we'll be closer to the vicinity of 15%. And I think the main difference from us being there versus the current 14.6% number is, the amortization charge from an accounting perspective that we had to take on some of the M&A activity that happened, in the last few months of ending of the year, right? So that caused a little bit of a headwind, which diluted the benchmark that we kind of outlined for ourselves. As we look forward for next year, I think good part is the actions that we've outlined for ourselves for giving us the positive momentum are starting to kick in. The structural actions on juniorization we've taken has already given us the headwind it had to on the utilization being lower. Now I think that will start turning around. Some of the investments we've made in areas of expanding our market to delivery centers to nearshore operations as well as tier 2 cities are also starting to help us on stemming attrition. So as we move forward, we'll see some of these investments giving us the benefit, and hence from a past perspective, I think that journey continues. But the pressure on the cost side, is relentless. It continues, right? That market is still strong. So hence all these actions from an execution perspective have to be implemented impeccably for us to continue the path. And that's what we are aspiring for as a team.
Sure. Thank you.
Thank you. The next question is from the line of Abhishek Shindarkar from InCred Capital. Please go ahead.
Hi. Thanks for the opportunity and congrats on the Q4. The first question is, can you give us a color about how the CY21 numbers look like for some of the larger acquisitions like Project Activist and Analysts? You had shared 9 months and 11 months data, and CTC as well, during the acquisition details. But any color in terms of, how CY21 full year numbers were and, see calendar 22 looks like. And the second question is on, the capital allocation. What is our strategy going forward? Any color on that could be helpful. Thank you for taking my questions.
Yeah, no worries. So maybe I'll take the capital allocation first. So as I mentioned, we continue to our policy is to keep on looking at niche and complementary assets that add us win in the marketplace. And situationally, we got good assets last year, which added up to, as somebody articulated, also a high M&A spend for us, right? Now, when we look at the following year, I think our focus is going to be more organic and ensuring that we assimilate all these acquisitions into the company from a cultural as well as go-to-market perspective, so that we can get long-term synergy benefits that we've envisioned with these assets, right? So that's going to be the focus. And from a capital allocation perspective, you see, while we had articulated over a patch of 3 years, whatever we earn as FCF minus the M&A spend, we'll return back to the shareholders. But this year, that math, if you just do is kind of giving us no return from a shareholder perspective. But still, we said in that situation also, we are comfortable with the cash balances we have, and hence we've dipped on that to continue to offer the similar return as last year's to shareholders, right? So that we continue to stick to our capital allocation policy that we'd articulated before, with a focus next year on more organic and assimilating these M&A. So that's on that. In terms of numbers of all the acquisitions, exactly for calendar year, I don't have it with me, but if you can offline touch base with Costa, whatever we've published, we'll share that with you. In terms of trend, all those acquisitions are being closely monitored. Vivek, who heads our M&A portfolio, maybe can add a comment, but we have a robust process ensuring that we continue to see growth in those portfolio, including the synergy revenue, and that visibility for calendar year 20 looks very positive.
Rohit, I think the only thing I would add is the numbers on those three specific acquisitions which were later in the year. We are pretty much on plan and working very closely with the management teams to drive synergy and growth. Apart from whatever is the organic growth plan of those businesses. That's a quick summary of how those specific ones are doing.
Great. Thank you for taking my question and best wishes for 23.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question for today. I now hand the conference over to Mr. Rohit Anand for closing comments. Over to you, sir.
Thank you. Just thanks for everybody for joining the call. I'll just recap the year for us. Top line growth of 17%, margin, EBIT expansion year-on-year basis. We've given record wins of 3.3 billion on deal wins, which is a 50% increase versus last year. All our significant verticals have grown, communication leading the way, and BFSI as big ones. And then, if you look at dividend, we've continued to continue to stay on the commitment we had on dividend to shareholders, and we've given altogether between interim and final dividend of 45 rupees. So overall, that's the summary for the year, and we'll continue to keep on working as we move next year for a similar performance. So thanks everybody for the support, and thanks for joining.
Thank you. Ladies and gentlemen, on behalf of Tech Mahindra Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect.